Victor, thanks very much for coming to appear on Real Vision. I've been really keen on this ever since a mutual friend of ours said, look, you guys should get together, because you've got a fascinating story to tell, particularly for part of this masterclass, but also because what you're doing now is very interesting. I just think it's a lovely story for people to tell. So give me a bit of background about yourself. Where did you grow up and went to university, and then we'll start talking about some of your career.
Sure. So I was born in New York City, and I lived the first little bit of my life there, and then sort of around the New York area in upstate New York and Pennsylvania. And when I was 13, I moved to Iran. My family moved to Iran. My father was born in Iran and came to the States in 1941 during the war. So I went to live in Iran and got immersed there, learned to speak Farsi, even though I had heard it around my father's family growing up, and wound up leaving Iran at the very end of '78, after the revolution was really in full swing, and banks and cinemas were burning down, and you got to see coming home on the school bus with no traffic laws being observed. And anyway, I went to the LSE, had a great time there, and right at the end was casting around for things. So I was actually thinking about going into computer science, and I had worked out in Cupertino for a subsidiary of Motorola for a summer before, and I was doing a lot of computer science. And anyway, I got this job at Solomon, and I guess that's in the research department, and maybe I should stop there, in New York. But my boss who hired me, Bob Koprash, wonderful, wonderful man. He was a professor up at Rensselaer and was writing some of the groundbreaking research at the time in terms of explaining the new instruments that were coming out in this deregulating bond market, fixed income market. So we were writing papers about caps and floors and interest rate swaps and cross-currency swaps and deliverability of bond futures and all these different things. And, Bob would basically write the paper, and he'd get me or some of the other researchers to make graphs and do some research and so on. And then he'd sort of put our name, on the paper underneath his. And, one thing that's just, that I think about frequently is that, there's something about youth when, that you have so much confidence in yourself, in what you see, and how you understand the world when you're young. Because you're lacking, one aspect of it is you're lacking in imagination. That as you get older and you see more things and you learn more about the different things that can happen in the world, you really lose confidence in your ability to predict anything.
Because the basic problem we had, and the financial markets have still a problem with this, is the inability to correctly price fat tails. So when it comes to the extreme outcomes, liquidity being the one, it was almost impossible to price. Everyone screwed up.
Right,
and
capital
just done it again
capital moves slowly. Right, capital moves slowly. Investors chase returns. I mean, there's lots of these behavioral aspects that really make that sort of business difficult.
Yeah, the new business you've started now, because it is very different from your past, but really equally interesting.
I realized, as strange as it sounds, that I didn't know how to invest for my family. So, I started to talk to people and try to find out how other people were doing it, and so I started to follow in that conventional way of sophisticated financial people, investing in private equity and other hedge funds and, venture capital and this and that. And slowly I just started to become kind of disillusioned with it for a variety of reasons. I guess, performance was probably one. Complexity was a really big one. I just felt like all of these investments were taking so much of my time, trying to figure out, which were the good ones to do, and then the flow of paperwork and subscriptions and redemptions coming back to me and managing cash flow. And then from a taxation point of view, the stuff was generally terrible. That if you're a taxable investor, that alternative investments tend to be really bad especially for U.S. Taxable investors. And I realized that there wasn't a good menu of options for that sort of thing. So I started to figure out how I wanted to do it, which was basically getting back to a more passive, index-based, diversified, long-only, cost and tax-efficient approach, but with some degree of responsiveness to the fact that every once in a while things, that a simple market cap, a simple static market cap approach doesn't really go the full distance in terms of giving you a long-term solution that you're going to want to live with. That if you do a market cap-based approach, at some point, the Japanese equity market's going to be 50% of your market cap weighted investments, and you're going to say, no, that's too much, and you'll intervene in some way. And you'll have a 2001 internet bubble, and you'll intervene in some way. And I didn't want to have to worry about intervening in an ad hoc, subjective way, in an undisciplined way, which I figured would probably wind up hurting. So that was really the genesis of Elm Partners, which was trying to provide this missing building block to people's investment portfolios. I wanted to provide a solution, an intelligent portfolio for sophisticated investors, low cost. We charge just 12 basis points, which I think is the right sort of fee for this type of thing. Global diversification, you'll never be forced to sell. Transparency, you know what to expect, and sort of a long-term sensible exposure to risk assets is what we're delivering.
What you've done in the end is almost the opposite of the complexity of long-term capital.
It is.
And the opaqueness of that. And you've gone for very liquid.
It is.
Very transparent.
Long only, no leverage, no shorting.
But you've tried to approach it with as much kind of intellectual rigor as you went about the long-term capital and the complex things you were trying to do there.
Well, I don't know about that, but yes, I mean, trying to be very thoughtful about it, and I wouldn't say that we've invented anything. We've sort of pulled together a lot of research that others have done. We've done some of our own research, as well, which we've published. I mean, there's a problem. I mean, people when left. I mean, my opinion is that people when left to their own devices, and I've seen it for myself. We just are not good natural, we're not programmed to be good natural investors. We chase returns, we get overconfident in bull markets. There's no 10-year period over that from 1975 to the present with this bigger expanse of things, there's no 10-year period where the value and momentum overlay didn't increase return and decrease risk. Not by a huge amount. We're talking about extra returns of 100 or 200 basis points a year, historically a bit more than that, but but drawdowns can be half as big as a static portfolio.
Great, Victor. Thank you very much for coming to see us.
Pleasure.
And hopefully we'll get back to talk about Elm at some point again soon.
Great. Thank you very much, Raoul. Really enjoyed that.
Thanks.